Well, good morning or good afternoon, depending what time of day it happens to be when you are joining us for our latest panel, and I'm grateful to be with you. I'm Eric Sussman, a longtime faculty member at UCLA Anderson. Probably have had few of you out there as students, punished you in the classroom at some time with a cold call or a terribly unfair B+. Anyways, this is my, I think, finishing up my 25th year here on the faculty. Have appointments in accounting and real estate, as most of you know. And outside of campus, I'm the managing partner of Clear Capital, a value-add multifamily real estate firm. I will be moderating our panel today to talk about what the heck is going on and all the interesting trends that are happening in our equity markets and with some sort of forward perspective. So let me just briefly introduce our three panelists. Again, grateful that you are taking time out of your busy days to join us today. We have Dr. Fei Li, who is the head of equities at Research Affiliates. She specializes in quantitative research, so she is our quant on the panel. So I look forward to having her educate me on all the things I don't understand about smart beta and factor investing, asset allocation, and the like. She has her bachelor's from Tsinghua University in China and her PhD from none other than UCLA in finance. So thank you. Nice to see you, Fei. We've got Joseph Shaposhnik, who's probably biggest claim to fame, along with our other panelists, as they were former students of mine. So God help all of us. Joseph is the chairperson and CEO of TCW SPAC. So you better tell us what the heck is going on in the SPAC market. Given that I am somewhat of a cynic, Joseph, so you'll have to, turn me around there. In addition, he's the managing director and portfolio manager of TCW's New America Premier Equities, Global Premier ESG Equities, and Global Space Technology Equities portfolios. That is a long list of portfolios. Undergrad from Berkeley, and then got his MBA down south at the school that really knows how to use the fight song. And that's UCLA Anderson in 2011. And again, took at least one of my classes, I think, Joseph. I don't remember which one, God knows. And then last and certainly not least, Chris Wright, who's a portfolio manager and senior research analyst at Kayne Anderson Rudnick Investment Management, focusing on research in financials and real estate, very close to my heart. Previous stints at Alvarez and Marsal and Houlihan Lokey. Undergrad at Wharton and got his MBA from Anderson in 2009. So again, we got some real UCLA Anderson people here, so that's terrific. Well, I don't want to, I'm big on getting right to the point and hitting you right over the head with the mallet. So let me just ask you, where do you all sort of see opportunities in what many of us consider certainly not an inexpensive market? I guess it's how expensive it maybe is up for perspective. But, where do you guys see opportunities? And then, sort of, how do you sort of expand your opportunities outside where you all focus because of maybe the market's pricing and its relative expensiveness as it works? So I don't know who wants to chime in first. I'll start with Chris. I don't know. I'll start with you, Chris, and then we'll just move around the horn. How's that sound? I don't know. Can I cold call you? Is that still allowed once you graduate?
I'm having flashbacks. Of being in class right now. Well, I guess a couple points. Number one, I would agree with your opening statement that it does seem like an expensive market. I look at things like, if you look at market cap to GDP at all-time highs, high yield spreads, your all-time lows, just a flurry of M&A activity, and even just think about how quickly the market has rebounded. It took 5 months for us to recover from the COVID-induced sell-off versus 5 years for the financial crisis. So there definitely is some buoyancy in the market. And so what I've been telling folks is proceed with caution and know what you own. I think those, you should operate under that assumption in any market, but I think much more so in today's environment. Our overall investment philosophy at Kayne Anderson is really focused on high quality businesses. And so that doesn't change even in this current market environment. But I will tell you, we are really putting pencil to paper and really thinking long and hard as far as the multiples that you're paying right now in the market. So it's a long way of saying, I don't think we've really changed our approach to the market. I think really it's much more so you have to really have a high level of conviction right now if you're willing to pay the prices that are being offered to you in the market today.
Chris, I'm going to push back. I just want to get some more more granularity. One of my favorite words.
Sure.
So what? And I certainly understand that. And I agree with you stick to your knittings and don't move too far afield on the risk curve. I mean, that's maybe the temptation here. But any specific areas are you still focused on? Sort of the traditional sort of more value-oriented industries in I don't know, pharma or other sectors that aren't maybe quite as pricey as some of the tech stocks? Anything more specific you can?
I would actually say that going the reverse, that we've tried to avoid being sucked in by this idea of the reopening trade and going into what we consider some lower quality businesses that might have a near-term cyclical bump just because there's a lot of pent-up demand that was built up when the economy shut down. And so trying to avoid being sucked into that just because that seems to be the rotation that is going on in the market right now. So I think it's really trying to avoid near-term thinking and staying focused on our North Star, which is owning high-quality businesses. Again, if you look at what's really outperformed since the announcements of the vaccines, it's really been, I would argue, companies that are lower on the credit quality spectrum and oftentimes are unprofitable companies. And we're just not willing to sacrifice our quality focus to go chase what seems to be like a near-term trade. So that's really more so what we're trying to do, is take some near-term pain and focus on the long term. That's really what we're trying to do right now.
All right, Dr. Lee, I'd love to hear from you. Of course, you're the quant person here, so you may have a different perspective. And then I'll get back to the finest dressed of the panelists, by the way. I will just say Joseph. Dr. Lee, what do you think in terms of opportunities in this
Sure.
not inexpensive market? Put it that way.
Yeah, absolutely. Now I feel obligated to start with some numbers. I think certainly the market looks expensive, in my opinion, overall. I think Shiller's PE for the States, now is 37 to 38, is an increase of more than 40% over a year ago. It's the second highest over the past century. The only time we see Shiller's PE higher than this level was actually right before the tech bubble burst. So based on research affiliates' expected return model, that really tells us US large cap will deliver investors slightly negative return above inflation over the next decade on a year-by-year basis. Higher price multiple and unprofitable business, we can see today an overwhelming US market. So investors should approach this with caution. I totally agree with Chris. I think market today is trending up in a much choppier way than last year because lots of the growth prospects has already been priced in. So my recommendation for investors is to focus more on the stocks and the segments with reasonable valuation, stocks with real earnings growth, the cyclical sectors, from the quant perspective, not only those are value buys, but also their recent performance create actually very positive momentum. The sectors such as industrials, materials, energies, financials, they have a high exposure to the economic recovery. So we think actually those sectors potentially will deliver pretty good return to investors over 3 to 6 months horizon. And also, I think investors can seek to diversify their portfolio away from U.S. markets into, emerging market countries, which potentially, benefit from a global economic recovery because they are pretty big on commodities, on exporting. And also, I think within developed countries, I would highly recommend that people consider UK, because UK actually is one of the largest economy in the world. Last year experienced a negative return because of COVID. They have relatively strict lockdown. Also because they have Brexit. And earlier this year, they reached a deal with the European Union. So lots of uncertainties due to Brexit has been removed. I think this country is making very fast progress, similar to US on vaccination. So I'm very positive on UK's future prospect.
Great. And Joseph, as I said, I couldn't help but notice the tie. Forgive me. There was a time when I wore a tie to class every day. I got over that habit, by the way, for the record. Anyways, maybe it was my hitting middle age. Anyways, just what are your thoughts on in terms of just the areas for opportunity in this nutty market?
It feels as though the market over the last 10 years has definitely moved from participants being reasonable and making reasonable judgments on good businesses to participants becoming much more aggressive in what they're willing to pay for businesses, much more aggressive with what they're willing to buy. Obviously Bitcoin is a great example of people being willing to go buy almost anything, regardless of whether it generates cash or earnings. So certainly as you take the temperature of the market, it definitely feels as though people's appetites for everything that's hot and aggressive is as high as it's been in quite a long time. With that being said, it is also true that interest rates are very, very low, and interest rates are a significant governor on what you can pay for good assets. So we are continuing to be focused on our investment approach, which is a focus on investing in predictable growth businesses that sell a critical product or service and that generate consistent free cash flow. And we're still finding opportunities in what is a more difficult market than it's been in quite a long time. But a lot of those high quality businesses have been to some degree left behind, because in the last 12 to 18 months, there's been tremendous energy and focus on businesses that grow revenues very, very quickly, but maybe they don't generate much in the way of free cash flow. Maybe they have business models that are not quite as sustainable as the very durable business models. So because of that, there have been some opportunities that have been left behind, and we're really focusing our energies on those businesses that are still relatively reasonably priced relative to the overall market, and have great businesses that'll be able to be sustainable as we move through the pandemic, and as people come back to valuing good businesses in appropriate ways.
All good comments. I have a question for you. Look, obviously from traditional metrics, the market looks expensive. You've already alluded to low interest rates. Several of you have. Question I have is also liquidity. I mean, there's something like $18 trillion in M1 money supply sitting on the sidelines. And I've always sensed that, as soon as sort of people feel more confident about the markets and recovery, that money's coming in to try to seek some actual, positive real return as opposed to negative real return. So does that change your thinking in terms of where the market goes from here over the next, year to 18 months? Is maybe some of that money from the traditional retail markets, who are often last to join the party, come in? Obviously, they've been doing a lot of buying of Bitcoin and a lot of risky assets generally. But any thoughts about that in terms of all that money sitting on the sidelines?
Yeah, I'm happy to. I'm sorry.
Yeah, anyone jump in. Hey, the cold calls are over. Now I'll sort of moderate it. You guys go.
Well, I'll give you a couple perspectives. One, I do cover banks, and it's been abundantly clear over the past year, after multiple rounds of PPP loans and stimulus dollars, that a lot of banks are sitting on a lot of excess liquidity. And all of these bankers are talking about, their line utilizations are down, cash deposits are up. So yeah, you could make the argument there is a lot of dry powder in the form of just literally cash sitting in banks that's waiting to be deployed, both by consumers as well as by businesses. And you're seeing reports now that businesses, as they're trying to ramp up their productions, they're having supply chain issues. Literally, there's so much demand coming in, they can't keep up with it because the supply chains have been disjointed with the shutdowns last year. So I think from that perspective, yes, that would be a very bullish stance that, look, we're going to see a real acceleration across the board, both from people putting money in the ground, concrete in the ground, factories coming alive again, as well as consumers spending because they've been locked up in their house. I don't disagree with that. I think that could be a nice short-term bump for the market. But as you think out over a multi-year time frame, I think inevitably there have to be some winners and losers. One thing that I think about, again, is covering real estate as well. Another kind of trend that has popped up is that a lot of companies are thinking long and hard about the SG&A reductions that they made last year, as well as their physical office footprint on a go-forward basis. And I think, if you think about one company's expenses, another company's revenue, if a lot of these costs that were taken out of the system last year, if those are truly sustainable, I think that's going to be a headwind to some businesses. Conversely, you can make the argument, the really bullish case, that some of these valuations are warranted because you can have this pent up demand, as well as much higher margins on a go-forward basis, because the cost cuts that you did last year are actually durable and sustainable. And that you're actually going to see much higher peak margins as business comes back online.
Other thoughts from Joseph Feifei?
Yeah, as I think about it, I spend a lot of time thinking about how our businesses will be impacted by inflation and inflation expectations. And from my perspective, it emphasizes the importance of being invested in relatively low capital intensity businesses that sell a very important product, that have the ability to pass on pricing and increases in material cost, increases in employment costs to their customers. So we're staying away from those businesses that have any sort of commodity exposure where pricing would be very difficult to pass on. And we're staying away from those businesses that will have to invest tremendous amounts of capital in the ground and then have very, very long periods of time to be able to be repaid on the investment that has been made. And so those businesses, I think, are a little bit more difficult to justify investment in at this point, given what could occur with inflation over the next couple of years.
So my thought basically is I think due to the pandemic, actually, lots of people sit at home. They have lots of flexibilities, and also the government issued a bunch of stimulus checks and also boosted the unemployment packages. So the disposable income for U.S. household actually didn't really decrease much during pandemic. Lots of it actually flew into the asset markets already. That's why we see that the bubble is being built up, like in the stock market, in the asset market, in maybe cryptocurrency market as well. I think going forward, because of the redundant cash sitting aside, I hope those investments will go into the real investment sectors, which actually helps to grow the economy in a real sense. I think this year actually the market had some sell-off in March, and this month overall S&P delivers slightly negative return as well. Those actually a good experience for investors to have. Otherwise, everybody thinks I'm the god of equity. I could just retire investing for another year, right? So I think this actually introduced some sense of risk into the retail investors' mindset. And potentially they can be more cautious about how do they direct their excess of cash into different venues in the future. And I also agree with Joseph. I think the inflation has some pressure to come up. I think ever since global financial crisis, actually U.S. household has been delivering. So they actually have lots of savings rates has been increasing over time, even more so during the pandemic. So I think just due to the demand side is actually being stimulated, but the supply side has been suppressed due to the disruption of supply chain and all the other stuff. If the economy can't recover enough on the supply side, I think the inflation risk becomes much more imminent.
By the way, are you trying to imply that Dogecoin is not adding value to the U.S. economy? I mean, gosh, I thought you panelists were really going to add value to our discussion. All right, enough of my cynicism.
It's adding value in a sense I don't understand, but
crypto will have to come up. I mean, I hope. Gosh, we could probably spend a whole time talking about crypto, and I'm sure we're all confused about it. I did a podcast episode on it. I mean, it's just remarkable. Look, we've sort of alluded. We've been skating around. Some more direct comments on the pandemic, on COVID. I am sort of just curious, I really am, in terms of, because I get asked this question all the time in terms of the real estate markets and housing and what's sort of more temporary, shorter term impacts that we've seen. Feifei, you just talked about some of those that are more sort of longer term structural changes that you think are going to have a permanent, or longer lasting sort of impact on the markets. I'd love to hear more about that from each of you. In terms of how COVID's affected the way you do business, the way you do research, your approaches, and then sort of thinking over the next 12 months, sort of recover from this, and then a longer term structural change that, I mean, again, whether it's supply chain issues that, Feifei, you mentioned, or something else. I'd love to just hear your thoughts about that. And again, Joseph, why don't you go first, since you, I think this will be the first time you're leading off. You're hitting off lead off here.
I think about the pandemic in two ways. One, it's interesting because most sell-offs, and I'll just talk about it from a investor practitioner's perspective, most sell-offs, we have a lot of experience in dealing with them, and having gone through many sell-offs and experienced them, you're accustomed to it and you're prepared for it. I felt as though what was different about this particular sell-off is there was added fear associated with your own personal health. So managing that fear was a new complexity that I had to deal with and our teams had to deal with as they had to make investment decisions in real time. And I think that hopefully we've learned a little bit about how to protect ourselves if something like that happens again. And at the same time, as somebody that has to make decisions, you have to continue to be mentally sharp and deal with what's going on in the outside world and in your life in a way to where you can continue to make very, very good decisions as the world evolves. So adapting to what was going on in the world from a health perspective, I think was a very, very important learning lesson. I think the second learning lesson for me is thinking about how your portfolio can be impacted by shocking and unforeseen events. And as you think about putting businesses together in a portfolio and investing other people's money, we have to be thinking about what can those unforeseen events look like in the future and plan for that and plan for how your portfolio is going to react in the future. Fortunately, with this pandemic and the decline that occurred, our portfolios performed well. But as an example, if there was a global cybersecurity incident where the internet was shut down for 7 days or 10 days, how would your portfolio perform? Those are some things to think about. So we think about that and continuing to scenario plan for the unexpected, I think is pretty important.
Dr. Lee, anything to add?
I would just add on again, the pandemic changed how people live their life. Lots of them stay at home and they have money which used to spend on traveling, dining outside. Now they can spend on their brokerage account. So I think when I look at the data, there is a huge surge of retail participation rate in the US market. It used to be about 5 percentage points pre-pandemic. Now is above 30%. So 1/3 of the total trades actually are created by retail investors. And this makes the market really interesting to watch because lots of their trading behaviors are highly speculative in nature. Many of them might be making money, but many of them are also losing money. And basically, I talked to my friends who didn't have a brokerage account until last year. Lots of activities they are doing are just extreme short-term momentum. If they have to use a quant language, they look at the near-term performance, then load very heavily on single stocks. So last year, we have seen the peculiar trading activities around penny stocks. When the company announced bankruptcy, suddenly, a bunch of money gets into this firm. And we have seen the wrong stocks price went super high above the roof because they have the right ticker. Zoom, Clubhouse is not actually the same company people thought they were investing in. So I think, generally speaking, as a quant manager, doing value investing, looking at fundamental is a big thing we focus on. This kind of short-term trading behavior typically prolong the bubble, makes the bubble bigger and last longer. This can be uncomfortable because that actually means value managers sometimes have to bear the pressure of underperformance over a prolonged period of time. But on the other hand, I think the positive side is the magnitude of the bubble is larger and it's typically associated with a bigger profit opportunity once, mean revert comes back to fundamental anchor.
By the way, I know some of you are posting questions, so I have a bunch that I'd like to ask. We'll see how our timing is, but I am mindful that there are some questions from the audience. I'll try to do my very best to throw those in there. Yeah, I've wondered just in response to some of your comments, Dr. Lee, is how many, a lot of folks are having problems getting jobs filled. It's amazing as the economy recovers. And one of the theories is that people are home trading stocks and Bitcoin and Dogecoin, and actually they're making more money doing that right now. So why do they want to be your waiter or waitress or your staff at the local restaurant? That's a very scary thought. I don't know how deep that is, but gosh, when I heard that. You did mention it, and several of you alluded to this whole value versus growth. And we've had this extended period of time where growth has outperformed value, and at least from traditional metrics that we look at, sort of these traditional value metrics. And I think, to my understanding, it's the longest period of underperformance ever in our markets, at least as long as we've been measuring these sorts of things. So again, I know this is one of those trite questions, and so don't throw me under the proverbial bus, but is value dead? Is it just, this theory, I know that its value is what it's value. Price is what you pay, value is what you get. So every time you buy something, you're thinking of value. It's just we're thinking of value in the wrong way. So anyways, I know, Chris, you had some thoughts on that. You and I exchanged some ideas about that. Anything yet?
Yeah.
Is value dead,
Yeah.
my friend, or it's just on life support, or it's...
No, I think you framed it well. Value investing is all investing from my perspective. And I actually think this nonstop debate about value versus growth is really kind of a disservice. And I think I would argue or hope people think a little bit deeper than just that. Number one, I'm not going to sit here and preach that one way of investing is better than all others. I think there's actually a lot of different ways to approach investing. But with respect to value versus growth, I think that just, again, kind of muddies the waters here. At the end of the day, as an investor, you're trying to evaluate the value of an asset, think about what it's worth, and that's really going to be based off of the future earnings power of that asset, that business, and then what are you paying for today? And hopefully you're paying a reasonable to attractive price for it. I would point people to, Howard Marks wrote a really great memo at the beginning of this year on this very topic. And even there's Jeremy Grantham, who is a well-known value investor, wrote in a 2010 article, really argued that, valuation metrics like price to book and price to earnings do not connotate intrinsic value whatsoever. And he describes a question he would pose audiences, which is something like this. He asked the audience, I will sell you Coca-Cola for 1.2 times book value or GM for 1 times book value. Raise your hands if you want GM. Lo and behold, no one raises their hand. And why is that? Because price to book does not connotate value. Instead, intuitively, everyone understands that there's a greater franchise value to Coca-Cola relative to GM. The question really is, what is that delta? What is the premium that you should be paying? Because that's where fundamental analysis comes in and evaluating the asset. So that's where I kind of push back on this debate on value versus growth. I think I think it muddies the water.
My God. Chris, I'd have to ask you, are you sure you don't want to pay 2 times GM's book? They're transitioning to EVs. They're so undervalued relative to Tesla. I think we have completely missed the boat on that. Joseph Feifei?
I'll take my Coca-Colas.
There you go. Joseph Feifei, thoughts on that, this whole value growth, and then Feifei, I'm going to give you some quant questions because I know you're the quant person on this panel, so I promise I won't leave you hanging. Thoughts on this whole value growth debate? Because I'm on the board, as many of you know, of Causeway Capital. It's something we're a value shop, and we had the same discussion. So I'd love to hear your thoughts as well.
I think that value investing in the last for quite a long period of time has emphasized buying very cheap, quantitatively measured securities. And that approach is a very, very difficult approach to execute over long periods of time because it does require constantly buying cheap stocks and then selling them. And that creates significant tax leakage and it creates a very, very significant margin for error. So I think value investing as defined in that manner is a very, very difficult approach to execute. My belief is that buying high quality businesses at reasonable prices and holding them for long periods of time is an approach which is easier to execute and has a larger margin of safety than the first approach. But of course, both approaches have been successful for different types of people. I also think, and we've talked about this in the preparation meeting that we had, that value investing seems to have decided that it's not going to focus on growing parts of the economy. And there are growing parts of the economy that are generating good returns on capital, that are generating cash flow, that are generating good growth and have secular opportunities, and that do at periods of time trade at reasonable multiples. And it's difficult to outperform if you're unwilling to at least consider those businesses that have become much larger parts of our lives and of the world. So I think that making sure that you continue to evaluate good businesses wherever they may be, whether they're in the industrial space or in technology or in other parts of the economy, I think is incredibly important. And I've tried to stay open-minded to businesses in technology, which don't come naturally to my understanding, but I do understand that there's a lot of growth opportunity there, and there will be sustainable businesses that continue to be built there that will have staying power. And so just trying to continue to stay open-minded, I think is very, very important.
Cool. Dr. Lee, if you want to answer that, I'll tell you what, I'm going to give you an option, Dr. Lee. You can either continue on this dialogue, or you can start telling us about the factors, the quantitative factors. Walk us through your process, the quantitative side of things. I know a lot of shops are now integrating quantitative investing along with the sort of traditional tried and true sort of fundamental approach. Just, I don't know, tell us about what you do, the factors you look at in terms of your research, and what do you see as the most significant factors these days that are sort of driving your investment models and theses?
So I could actually just combine the two questions together.
All right.
Yes. So when we talk about factor investing, we define a framework for identifying robust factors. What are robust factors? First of all, it has to be based on academic literature, because we do believe factors can provide persistent premium going forward for investors for a reason. If there's no literature, often it just means it's a one-time event. It wouldn't repeat itself in the future. When we come to value investing, in academic work, there are both risk explanations and also behavior explanations. I think behavior side is very easy for people to understand. Most investors have the tendency to chase stocks which are doing really well and abandon stocks which are underappreciated by the market. So over time, this actually, basically the capital allocation is not really consistent with a company's growth perspective, but rather consistent with market perception. But at any given point in time, the market perception can have an error in it. So that's why value can actually deliver value. So I think that's the academic literature support. Then we also look at value and among other factors, whether they are robust across different sample periods, across different geographical regions. And value actually is one of the most robust factors from the quantitative evidence perspective. I think the third one is to look at the definition. If there is a definition perturbation, which means if your signal is defined slightly different by the changing of the denominator, by the scalar or whatever, value can be defined as book to price, can be also defined as earnings to price, dividend yield. Right? Does the main premium documented in the literature still survive? Lastly, we also make sure, given real life market friction, trading cost, the ballpark of the premium in your empirical backtest still survive. I think actually value passed like all those criteria pretty well. But why value actually underperformed over past, I think 13, almost 14 years. I think it peaked in 2007, end of 2007, then had more than a decade of underperformance. My colleagues actually published a paper early this year or sometime last year. I think it's called Reports of Value Stats, maybe greatly exaggerated. So they attributed the underperformance of value into, I think, three aspects. The first one is, the traditional farmer French book to price matrix tend to miss the important components coming from intangibles. When the economy is evolving from, traditional manufacturing based to more technology information based, lots of companies, modern companies actually invest a lot into R&D cost and also spend a lot of money on relationship building, creating branding, marketing, etc. So those are all intangibles. I think the traditional matrix just miss that part. Secondly, I think they also talked about the revaluation alpha. Large proportion of the underperformance of value versus growth was caused by the increasing gap between price multiple of value companies versus growth companies. In another word, it just means value companies are getting cheaper and cheaper relative to growth companies over the past decade. And some of this, trend was just driven by market participants, irrational behavior. I think lastly, they also said it's might just be a lifestyle event. It just means it's very rare. Before market actually rebounded from, I think, Q4 last year, when we look at the valuation gap between value versus growth segments of the market, it was the widest. It went off the chart. It's like 100 percentile over the entire history. That actually means value stocks became really, really attractive. So over past, I think 6 months, we have seen really strong performance coming to those value companies, especially because, they actually really tremendously benefited from the resumed mobility, during pandemic, I think they were really depressed because lots of value companies require close contact. And lots of growth companies, they have a higher margin, they have more profit. It makes them much more adaptive to the new pandemic environment. So value companies was really depressed because of multiple reasons. But overall, I think investors should really be very cautious about what factors to choose, what factors to lose faith about. Don't lose faith when you are supposed to double down your bet. But based on the framework we defined, we also favor quality approach. We do favor momentum, but momentum actually trading cost could be dominantly high. So for momentum, we don't offer a standalone strategy, but rather we combine that with other factors for the investors to eliminate some of the trades. We also favor low risk factors. And in the size factor, the small segment of the market, we actually recommend having a combination of all those different factors because we think in the small segment of the market, price discovery process is slower, market inefficiency is bigger. So if you can actually do all this factor investing in the small space, you harvest a bigger premium.
Thank you. That was very, very thorough and I think a lot of really good comments. A couple more thoughts, and I know there's some questions pending. I have to ask you, and I'm not sure that I have a good articulate question here, but obviously cryptos and SPAC, obviously, and not just thinking as investments, of course, at least on the crypto side. Look, you've got firms like Overstock, MicroStrategy, Tesla's made some announcements, Coinbase's IPO, of course. So it's now sort of creeping, if more than creeping its way into the equity markets more broadly. SPACs, of course, well, we've had over 300 IPOs this year alone, and it's, my God, frothy is not a shame. I actually taught SPACs last night. So I just want thoughts about the impact on the equity markets from both of these things. I mean, Joseph, I'll start with you because you're the, what did I call you? The CEO of a TCW SPAC. Look at you. I don't know. I'm glad you probably weren't in class last night. You probably would not have liked some of the things that I had to say. So I'll start with you. Tell us about SPACs. Let's start there because that's something you should, I'm sure, know a lot about.
Well, I think SPACs are a public market response to a very long-term trend that has occurred over the last 25 years or so. The number of public businesses has declined by 65 to 70% over the last 25 years. And private businesses are staying private for longer periods of time than they ever have. So to an extent, this is a response by the public markets to try and attract some private businesses that have stayed private for long periods of time for various reasons. At the same time, it's also in some ways, a more efficient and faster way to come to the market. And in some ways, it could also be a less expensive way of coming to the market as well. So it will have a role in the public equity markets, I believe, for a long period of time, but certainly not at the rate at which we saw over the last nine months or so, the last 12 months or so. But it will play a role. There will be SPAC operators that can add value to those businesses that they transact with. And to the extent that the SPAC sponsors are good at selecting high quality businesses that trade at reasonable prices and can then help those businesses either with capital, with talent, with relationships to help those businesses grow and create value that they couldn't have done on their own, there will be a place for those SPAC sponsors. For many, many others that are not able to add value, select businesses well, or help those businesses, I would not expect them to be able to come back to the markets with another SPAC in the next, in the future, if at all, but certainly not in the next 6 months, where I think things will slow down significantly. So, we'll see what happens. Up until a couple of years ago, there were very few SPACs that were ever launched. I've listened to your podcast. I think that you're exactly right in that, by and large, they have not been a successful asset class to invest in. They've underperformed the market. But what I also think about that is most active managers underperform the market. So there are a few that can outperform the market, and I think there will be a few SPAC operators that will be able to add value and deliver good performance. And as in active equities, there'll be a lot that underperform, and they won't be around for very long.
Yeah, well, I've got all my money on the Shaq, Alex Rodriguez, Jay-Z SPAC. That's where I'm putting all my UC retirement dollars. Yeah, Josie, you obviously heard my cynicism about SPACs. I guess I have this sort of visceral response to Wall Street and acronyms. I don't know why it is. When I hear Wall Street peddling acronyms, I guess after all these years, I have a visceral sort of response. And that covers the SPAC space, and I think it was well articulated, Joseph. Crypto, I mean, look, it gets so much airtime. Needless to say, we've already alluded to it a little bit here. I want to look at it from a little bit different perspective. I think we all would agree that the combined worth of what Ethereum, Dogecoin, and Bitcoin is now bigger than our entire GDP or something, whatever. And we all know there's froth there. But I'm looking at it from a different perspective in terms of, again, the equity markets. As I said, Coinbase's IPO being one thing, of course, but as I said, MicroStrategy has invested, I think, virtually billions of its cash in Bitcoin. Tesla's now, I mean, again, I'm not sure how much of that is this promotional. Overstock, again, same thing. These firms are sort of, now we have this sort of merging of the equity markets and crypto in some interesting ways. I don't know, Feifei, Chris, thoughts about that on those points, if anything?
I certainly would not be drawn to companies, from my perspective, that are actively deploying their treasury capital into buying Bitcoin. I do say it seems quite speculative. Just a quick anecdote. I had a window installer at my house a few weeks ago, and as soon as he found out that I was in the investment management profession, what do you think his first question was? What do I think about Bitcoin? So I'm not sure if that's the canary in the coal mine or not, but look, I'm certainly not an expert on the space, but it does seem to be a bit speculative from my perspective. And it is, I think, a little bit worrisome to have something like MicroStrategy, where I would attribute the huge run up in its value is because it bought Bitcoin, not because of its underlying business. Right. And so really it's become a security that's tracked. It's just tracking cryptocurrency and not any kind of real fundamental business. But I will say there is some, I think, underlying intriguing things with respect to cryptocurrency as far as instantaneous transactions that can be recorded on a distributed ledger. I think there clearly could be a lot of different applications of that. But just like the internet back in its early days, it could be something great. Whether or not who's the winner right now, I think it's still very early days. And I certainly would not be spending my time trying to figure out which cryptocurrency to buy for our investor base. But I think there's some interesting applications for the underlying.
Of course. Well, we all agree that and all some kinds. I mean, Dr. Lee, I assume crypto is not in one of your factors, in one of your quantitative factors?
It doesn't have enough history for us to analyze. But, one of my coworkers, actually, one of my team members actually quit the firm a few years ago to pursue his dream of, cryptocurrency. And he actually opened a shop to mine Bitcoin. But of course, his business was really hit very hard during, I think, 2019, when Bitcoin lost 80% of its value. So he actually came back and continued working for Research Affiliate again. And he wrote an article earlier this year regarding his view on Bitcoin. I remember, today he really thinks Bitcoin price movement has been very speculative. And I, under his influence, a few years ago, opened my Coinbase account because I thought it's just fascinating to trade. But I don't trade a lot. I clearly understand it's not about investment. When I do this trading, it's about it's a little like gambling. It's for fun. It's for personal pleasure. I think Bitcoin many years ago had some potential because the online payment method, I think, was very underdeveloped in the U.S. market. And also, I think Bitcoin, I think, has a limited supply. But today, I think the scenario changed tremendously. If we look at Venmo, we look at Zelle, like lots of Apple Pay, lots of online payment actually is very convenient. and transaction cost free for consumers. In addition, Bitcoin has a huge volatility, right? So it's really hard for me to think about Bitcoin as a way to store value or to help investors to preserve their wealth. I would just it's not in our company's strategy offering. I think we will remain open-minded about it. Maybe once we accumulated enough data for analysis, we would consider to do something. Not today.
Yeah, I think one other element on Bitcoin is that may be a little bit underappreciated, and this is going on in a lot of assets, is the massive amount of leverage that's being used to inflate and purchase these securities. There's so much leverage in the system. One of the primary drivers of that is a very, very low interest rate environment. And, the environment of the last year or two where people are staying at home but still receiving income and additional income, it has really created a combustible situation where rates are very low. You can receive tremendous amount of leverage to buy ultra speculative assets. And that is really fueling a very, very dangerous situation, I think, in some of these assets. And it very well may be that Bitcoin is a sustainable asset in the future. And I wouldn't dismiss it. I don't know what to do with it right now. I don't know how to value it. But the amount of leverage that's in that particular area is really incredible. So it's just something that I worry about. And, one of the other things that I also worry about is it could have been ignored a couple of years ago as something that investors didn't need to consider. But as it's become a much larger force as a potential asset, at a minimum, it needs to be studied and needs to be considered as to its viability and its value, because it definitely is taking a lot of attention. It definitely is absorbing a lot of capital. And to some investors, it is becoming an alternative to equities and other assets.
Yeah, it's probably not going to shock you. I did a podcast episode on Bitcoin and crypto as well. And for what it's worth, from my standpoint, I think digital currencies are here to stay, but the biggest risk to all of them is regulation and central bank participation. I just don't see the Chinese central bank or the U.S. central bank sitting there allowing erosion of their currency through these cryptos. They'll come up with their own digital currencies. I think that's that, and of course, I think regulation. You mark my words. I'm telling you, I've told students this, that the IRS is going to announce the arrest and prosecution of some young people for not reporting their taxes. Now on the very front page of the 1040, they ask right on the front page on the 1040, have you exchanging transactions with Bitcoin or cryptocurrencies? And there'll be a lot of people who say no, and they're going to find out that they did, and you'll see that's going to be a real interesting situation. But that's my opinion. I'll leave it for that another day. There are a couple specific questions that have come in, and I thought, well, given the timing and everything else, I'll throw some out there specifically. Fei, Dr. Lee, someone asked about, of course, they jumped right on your comment about the UK market and where you're looking. So they want, of course, more granularity, small cap stocks, what you're looking in that market. Everyone wants to know what they ought to buy. I don't know. So is there anything you want to say more specifically or, granularly about that UK market and small caps?
Oh, that's harder because I'm not a registered investment advisor. I cannot really give out any tickers. I would say UK market as a whole actually is attractive. Then, given today's, global economic recovery, I'm also more positive on the value side of things, on the cyclical sectors. So I think maybe a viable approach is to, search for ETFs, which give you exposure to British, value companies. Or certain cyclical sectors like industrials or materials.
Fair enough. That makes sense. Chris, I have to ask you, since I'm moderating this panel, for sure. I think probably some UCLA Anderson swag, which I probably don't need. I want to ask you a selfish question. That's on real estate. That's one of the sectors I know you're really interested in. And it's look, it's 15 to 18% of our GDP, so it's certainly something I should ask you about. Yeah. Everyone's interest. There's obviously a tremendous, I call it demographic diaspora, some demographic trends. Obviously, movement of population from the coasts both to the Sun Belt, Southwest region. You have some of those trends. You have very low fertility rates, record low fertility rates in the United States now, household formation. I don't know, given sort of those things, I'm really curious, what are you looking at from your research in terms of the real estate market, those demographic shifts that are really, I think, long lasting, significant on the United States? Certainly, again, these fertility rates, which mean population growth without good immigration policy, is really an issue. Anyways, just some thoughts about that you can share with us and how it might be affecting your investment theses and approaches.
Sure. So I guess a couple points there. Number one, a number of years ago, really after the financial crisis, there's the real genesis of this business model of ownership, private equity ownership, or private ownership of single-family homes. And I think a lot of people looked askance at that you're able to buy assets on the cheap, and that that was not a repeatable business model. That just because you got all of these single family homes basically at auction. But I think what you've seen over time is that they've actually been able to prove out a real viable business model. And in fact, what's happened more recently is people have started to flee the urban centers to suburbs, and that's been a tailwind for that business. And so I think that's really helped, possibly solidify that model. And so I've kind of done a bit of a 180 of being more of a skeptic of those businesses to actually taking a much more positive look at those. But I think related to that, not necessarily tied to residential, but really on commercial. And you had asked the question earlier as far as kind of structural changes due to the pandemic. The one thing that I think long and hard about, and I have the benefit of talking to a lot of different management teams, not just in real estate, but just bankers, fintech companies, insurance company executives all across the board. And it's pretty clear that from those discussions, the T&E expense line item and the rent expense line item for a lot of companies is coming under serious review. And so in particular for real estate, I don't think it's just a short-term issue where companies are going to kind of scale back their office footprints. I think really people are thinking long and hard as far as what do you really need as far as fixed assets? What do you really need as far as office space on a go-forward basis? I don't, I don't view that as a short term. I think that there's some real legs to that, and that is certainly influencing how I'm approaching commercial real estate, in particular office space. And so that's a place where I think there's a really big question mark, and it's not necessarily a space that we've been focused on in the past, and it's certainly not now a place that we're spending a lot of time on right now.
I agree 1,000%. I want to ask a question, and I know we've got about less than 10 minutes now, close to 5 minutes. I want to ask about, we've alluded to, we've kind of skirted around a little bit, and that's interest rate and inflation. I always want to put you on the spot with predictions, but there are inflationary pressures. We know it's CPI, PPI, commodity prices. You've all alluded to it, and we all know. And meanwhile, we've got the 10-year still trading at 160. How long, and really, and the 10-year peaked at 180 maybe that's 6 weeks ago or something. It's kind of trickled back down. How does that play out? In terms of that tightrope the Fed is walking, we're going to have these inflationary pressures, and the economy is going to be certainly growing as we emerge from COVID, and how that plays out in terms of interest rate, shifts. Janet Yellen kind of made some comments the other day. You may have seen we're kind of backtracking a little bit from this, we're going to wait till 2023 thing. I don't know, just some thoughts about where you see interest rates over the next year and the Fed. And then just anyone jump in. Joseph, I guess you want to start with us this time?
I wish I could pass the baton to somebody else because I'm not great on the macro. I guess I would say from a equity investor's perspective, we really focus our time on the micro. So we don't spend very much time on the macro. And I've always believed that focusing on selecting good businesses could help you overcome whatever macro tide you might face at a given point in time over long periods of time. It feels as though inflationary pressures are as strong as they've been in a very, very long period of time. And we are definitely thinking about that as we select businesses, as we make investment decisions. And we feel as though that's going to be a very, very persistent trend for the next, for the intermediate term. It feels as though rates are going up, and it feels as though inflation is going up as well. The policy from the U.S. government, the policy from the Fed, I think in general is going to foster that type of environment.
That's true. You did a good, for not being a macro person, you did pretty well there with that cold call there, because it's true. You didn't know it was coming. Dr. Lee Fei, what do you what are your thoughts? You must, because again, in terms of your factors and all that, I assume you have some thoughts on this. You're a PhD in finance from the Anderson School, so you better.
Yeah, I didn't learn macro from Anderson School, but I am interested in reading macro news, and I think that actually does, at least from the equity allocation perspective, it helps. My reading of the inflation is, first of all, the inflation risk today is not super high, because I think inflation typically ticks up a little bit as a natural process when the economy is on the recovery phase. It happens, because price goes up a little higher. But on the other hand, the inflation could become a real risk if, the government excessively rely on printing money as the only solution for all the problems we have. So right now, I think the amount of, the money injected into the economy is okay. It perhaps can be absorbed pretty healthily by the economy. But, way more than that will impose a very significant risk. Once the inflation is out of control, a bunch of bad things could happen. But right now, a relatively modest price raise is not concerning. I think the government needs to draw a very fine line. They cannot rely on disaster recovery plan to provide a persistently lasting stimulus to the economy. I think that's quite critical. Then the other side is, inflation is often driven by the supply-demand relationship in the short term, in my opinion. So it's demand and the supply. Now the supply is lagging demand. That's why the price is rising. It actually is supposed to help with the economy because suppliers, producers have more incentive to produce. But it also requires basically a good control of the COVID situation. So the supply and production can really open up and catch up with the demand side. If I look at the government policy, I think that policy is a little different from the short-term relationship because monetary policy is supposed to support the economic growth in the medium to longer term. It's supposed to maximize employment. So I think, Professor Sussman, you just mentioned that the unemployment level is still relatively high for the states, at least comparing with pre-pandemic level, especially certain sectors, hospitality, dining, the service industry. I think you still see around a double-digit unemployment rate. In this condition, I don't think the government is going to pull the trigger to raise the rates at any near horizon, not until the end of this year. I would say maybe not even until the first half of 2022. However, I think the government is also, my opinion, I also think the government is quite concerned about the bubble is being built in the asset markets. So they, during the March sell-off, lots of the fear was driven by inflation will induce rate hike. I think the government choose not to do anything because they can certainly do, duration management. They can, do their yield curve control through their quantitative easing program. They didn't do any of those. So my story is actually Fed wants to have a little bit of fear in the marketplace to make sure the bubble is not crazy. I would say maybe Yellen was thinking along the same line to give people some caution, when you approach the market. On the other hand, I would also say if the Fed ever starts, raising the rates, I think it will be after they reduce the quantitative easing first. So I think the repurchasing of the mortgage-backed security and the treasury will happen first before they raise the rates. So raise the rates perhaps wouldn't happen until later next year or even 2023. That's my opinion.
Hey, Dr. Lee, you got to come join the faculty with those kind of thorough responses. You left a lot of really interesting thoughts. Look, we're at 12:31, so we're, I think, at our time, and I want to be mindful and respectful of everybody's time. There's so much to talk about, obviously, and I had a bunch of questions, obviously, we didn't even get to. When I have three panelists like you and my own verbosity, I guess it's a lethal combination. But in any event, and for those of you who had questions, I apologize. I think you probably can reach out in some cases to the panelists directly. I assume you have their contact information. You can certainly, those of you always welcome to reach out to me. Just pay that alumni consulting fee for those of you that are alums. But in any event, I really want to thank all three of you for joining us today and giving us your thoughts. Again, no lack of things to talk about. So thanks a million. And thanks for also being such great stewards of the Anderson brand and the school. I know I speak for Lori and all of us. Thank you very much for that and for participating. Hopefully next year in person. Let's all hope that would sure be nice. Yeah. So with that, now this is where I don't know what the next steps are. I assume our stalwart staff will take over or something like that. There is Lori on cue.
So thank you so much, Professor Sussman and Fei, Joseph, and Chris. Thank you. And as Professor Sussman said, thank you so much for representing Anderson so well and for sharing your insights with us. For the participants, we invite you, if you'd like, to continue this dialogue in one of the breakout rooms that you'll be getting a pop-up for again. And once again, just a very strong virtual round of applause. Mine's real, not virtual, for your time and your participation and your engagement. And we look forward very much to welcoming you back to school once we all go back to school. So thank you again.
Thanks, everyone.